Hello there, Hector Davil here. Today we're going to talk about the deviation, which is an important concept as far as trading the news goes. In fact, the deviation is what makes your chart, your Forex chart, spike around news announcements. It's not the news in themselves. What drives price crazy is the deviation in the news. Now, what does that mean? What is this deviation concept about? Well, it's the difference between the expected outcome of the news and the actual outcome of the news. Okay, here is the idea. In one hand, we have what we call in the Forex lingo the analysts. Right, the market analysts, which are, let's say, research specialists working for Reuters, working for Bloomberg, CNBC, CNN, you know, that kind of stuff. And their job is basically to research through the economy and through the different fields within the economy, trying to gauge an idea of, the health, the economical shape of a country, right? And obviously, again, through their own research, they come out with what we call the expected outcome of any particular news announcements. Let's say that next week we are going to have the unemployment data or the inflation data coming from, United States. All right, we have the inflation data coming out from United States. Well, these guys, through their own research, once again, they release an expected figure for that particular report. Okay, and then on the news announcement releasing date, the government, the official sources, come out with the actual outcome. Okay, they basically do release the actual report, and then, the actual outcome for the inflation data is actually made public for everyone to see. Well, what makes price spike and what drives price, chaotic, what punches in this massive volatility around news announcements is not the actual outcome, but rather how surprising that outcome was. All right. Basically, what the market does is they compare what the market analysts were expecting as a normal, and then they compare it again with the actual outcome. If the actual outcome falls more or less in line with what the market was foreseeing, all right, with what those analysts were calculating, then the impact on the price is going to be just very mild, all right, very mild, or maybe just it will have no impact at all right, as long as the outcome is in line with what the market was expecting. There is no surprise there, and therefore the markets do not either, trade in panic, in fear, in greed. None of the emotions kick in. On the other hand, if the actual outcome is rather surprising, all right, rather surprising as per what the market was expecting, there's where you see that, emotions kicking in, traders either entering into a trade or exiting, rushing out of a trade, and that's where the volatility kicks in. Okay, so to wrap it up, and please pay attention here, guys, this is important. What matters is not the actual outcome. All right, the actual outcome does not matter at all. It doesn't matter whether the outcome is positive for the economy or negative for the economy. It doesn't matter at all. The only thing that matters is whether that outcome is better than what the market was expecting, and therefore price will go up, or worse than what the market was expecting, and therefore price will go down. All right. In fact, you can see price going up on a rather negative actual outcome. As long as that actual outcome is better with what the market was expected, price can still go up, even if the outcome was bad in itself. All right? All right, let me give you an example. Let's imagine we have for today afternoon the non-farm payrolls being released. The non-farm payrolls is the unemployment claims from the United States. All right, so like I say, it's being released today afternoon, and well, we take a quick look into our economical calendar, and we see that the market analysts are foreseeing a 500,000 unemployment claims report, 500,000 unemployment claims outcome. That means that 500,000 people have lost their jobs throughout the last month. By the way, the non-farm payrolls report is released every month. All right, so that would mean that again 500,000 people have lost their jobs in the last month, which is obviously pretty bad. I mean, that's 500,000 new jobless people is pretty bad for the economy as a whole, isn't it? But anyway, we wait for the actual report to be released, and we see that the actual outcome, right, the official figures are only, and only goes in flying quotes here, 400,000 people. Unemployment claims, meaning that only, and again flying quotes there, only 400,000 people have lost their jobs throughout the last month. Now, in absolute terms, this is still horrible for the economy. All right, this is still an awful outcome for the non-farm payrolls. 400,000 people have lost their jobs. Awful thing. However, it is better than what we were expecting. In fact, it's a 20% better than what we were expecting as a whole, what the market analysts had foreseen. And therefore, guess what? The price for the American dollar should go up due to this news announcement. Yes, I know this is still terrible. Yes, I know these signals, the economy being in pretty bad shape, but still, it's not as bad and as what we had expected. It's not as bad as what we thought it was gonna be like. So price should go up because of this event. All right. Anyway, let me now pull out my forexfactory.com economical calendar, and I'm gonna show you how to read the expected and the actual outcome. All right, here we are at the Forex Factory calendar. Let me push this a little bit to the right, and as you can see here on the right end, we have few different columns. All right, few different columns with the actual forecast and previous figures for every particular news announcement. Let's pick a random one. For example, here the retail sales for Australia. All right. Well, as we can see, this particular day, the actual figure was 1.2%. All right, the market analysts were expecting a 0.8%, and this is the previous figure. That means that the previous month, last month, this same particular news announcement from Australia came out at minus 0.9%. I personally don't care about whatever happened last month. All right, I only care for the actual outcome and the forecast, meaning the expected outcome. All right, now let's go back. This is again the retail sales for Australia, and like I say, as we can see, the market was expecting a 0.8%, and once the news was actually released, it was released at 1.2%. As you can see, it's colored in green because it's higher than what the market was expecting. All right, it's in fact 0.4% better than what the market was expecting here. In the other hand, we see the building approvals, all right, which belongs obviously to the housing and construction field, also for Australia. The market was expecting a growth of 0.7%, and in fact, wow, this is pretty bad. In fact, the market came down, all right, the number of building approvals was down to minus 7.0%. All right, much worse than expected, and therefore we see that printed in red. Whenever they fall in line, such as in here for the cash rate news announcement, the market was expecting 4%, then the outcome was also 4%. We probably saw no impact on any Australian dollar cross out of this news announcement. Okay, probably at this precise time we saw no major market move because of that, because the expected and the actual outcome more or less fall in line. In the other hand, we should certainly see some chaotic wild price spikes due to these deviations here, both on the building approvals and on the retail sales, which, as we can see, they are both for the Australian dollar, and both of them released at the same time.